There are many ways you can try to reduce your tax bill. Unfortunately, they're wrapped up in a complex, ever-changing tax code, so it's easy to miss them. But here are 3 that you need to know about. When you file your taxes, you have 2 options for reducing your taxable income. You can take the standard deduction, or you can choose to itemize deductions. The Tax Cuts and Jobs Act of 2017 raised the standard deduction and reduced common big deductions, like the deduction for state and local taxes. The result? Itemizing doesn't make sense for as many taxpayers. However, you may be able to claim some special deductions even if you take the standard deduction. Those are called above-the-line deductions or adjustments to income. Above-the-line deductions include some retirement contributions, business expenses, some alimony payments, tuition and fees, student loan interest, and half the self-employment tax. It's worth looking at all your possible deductions and doing the math. And if you do opt for the standard deduction, make sure to claim any above-the-line items that you can. Another thing people often miss is tax credits. Tax credits are different from deductions, and they're actually more valuable. A tax deduction reduces your taxable income, but a tax credit reduces the tax itself. For example, a $1,000 tax deduction lowers your taxable income by $1,000. That could save you $370 in taxes if you're in the highest tax bracket. A $1,000 tax credit saves you $1,000 in taxes. If the credit is refundable, it can even put cash in your pocket. To take a tax credit, you need to know you qualify for it. The U.S. government offers tax credits to parents of young children, low to moderate income earners, and people paying tuition, among others. The IRS website offers a comprehensive list of credits and deductions. It's worth reading over the list carefully to make sure you haven't overlooked some serious savings. A third common tax mistake, not making the most of tax-advantaged retirement accounts. You may know that contributions to your 401k are deductible in the year you make them. But did you know that if you make IRA contributions between January 1st and the tax deadline, you can apply them to the previous year's taxes? As long as you qualify for deductible contributions and didn't reach your max last year, you can still contribute this year to reduce last year's tax bill. And since the payment applies to last year's taxes, it won't reduce the amount you can contribute in 2021. That's a win-win situation, and when it comes to taxes, that's a rare and valuable thing.